We will now look with you at ratio analysis, liquidity ratios. Ratio is a relationship between two numbers of the same kind. For example, if there are 2 apples and 3 oranges, the ratio of the number of apples to the number of oranges will be 2 to 3. A financial ratio is a measure of the relative magnitude of 2 selected numerical values which are taken from companies' financial statements. But instead of apples and oranges, we will have financial statements. To perform a comprehensive analysis, we will use qualitative information about the company and we will consider it in the ratios. For example, one business may have a completely different product mix than another company, even though both operate in the same broad industry. Now, how to determine how well one company is doing relatively to another? Or how to identify whether key indicators are changing? We will compare ratios to the average industry ratios. To determine trends in the company's performance, ratios are often compared to past years' ratios of the same company. Now we will look at several types of ratios. We will start with liquidity ratios, which represent short-term solvency. We will then move to financial leverage ratios, which are long-term solvency. The turnover ratios go right after that and relates to the asset management. Then we will look at profitability ratios and market value ratios. Finally. Now, short-term and long-term financing strategies will both have their advantages. The advantage of short-term debt, under the short-term debt, we usually understand the debt which is repayable within 1 year of the balance sheet date. And the main advantage of such debt is that it often does not require paying interest payments to the creditors. For example, if you look at accounts payable, they might not require payment of interest if they are paid within the first 30 days, while they are outstanding, right? The short-term debt also has its disadvantages. The payment will be required within at least 1 year, and often sooner. Here, interest rates on short-term debt are often higher than on the long-term debt. Compare loan provided for 6 months to the loan provided for 5 years. Which one will have the lowest rate? Now, what is liquidity? We start with liquidity ratios. We understand an increase in the proportion of short-term debt, which is more risky, and we start with this analysis because it must be renewed and therefore will be regenerated more frequently. Under the liquidity, we understand the ability to pay current liabilities, implying a short-term perspective, as you already know, which is within 1 year period. Now, liquidity ratios include several types of ratios which are often used by most of analysts. And you will definitely come across with these ratios in most financial analysis. We will start with current ratio. Current ratio measures the adequacy of the company's current assets to meet current liabilities. And this is just current assets over the current liabilities. So current assets can be easily taken from the balance sheet as well as current liabilities. The higher ratio will usually indicate high level of liquidity, which means that company has more liquid assets. The greater ability to meet short-term obligations. Here, rising receivables due to the delays in the receipt of the amounts due from the customers will be also a good signal to act. The company might also be increasing inventory levels or accumulating high cash balances. A relatively low ratio will indicate us that in this company the level of liquidity is quite low, which means that company has more assets which are not that liquid. The greater reliance on operating cash flow will be represented here, and the greater reliance on outside financing. Traditionally, a current ratio of those two was often regarded as safe. More recently, ratios of closer to 1.5 are increasingly being regarded as acceptable. Now, quick ratio or acid test ratio. This ratio will measure the relationship between current assets, excluding inventory, and current liabilities. The numerator here specifically excludes inventory, which is deemed to be the least liquid of all current assets, right? Inventory is something which company holds for more than 1 year. That's why we do not include it in our analysis here. In this sense, the furthest turning into cash will be delayed if we include the inventory in these calculations. Now, such ratio will provide us more conservative assessment of company's liquidity. The level which is typically expected to meet is somewhere in the range between 1 to 0.7. Now let's look at the solvency ratios. We will now look at solvency ratios. First of all, what is solvency? Under the solvency, we usually understand the company's ability to meet its long-term obligations. Remember, the definition of long-term obligation usually refers to the obligations which exceed 1 year period. This ratio may be expressed in two main ways. First, debt-to-equity ratio, which is debt over the equity, and debt to capital employed, debt over the capital employed. As you may understand, all these numbers can be easily get from balance sheet and income statement. The characteristics of highly geared business lay in the following areas. First of all, the company which is highly geared has lower risk which is faced by providers of debt, which means that company will be able to attract more funding via issuing debt instruments. Another issue is there is tax deductibility of interest payments. When you issue a debt, you can assume that the taxes might be deducted in accordance with the interest payments. Next, there is lower weighted average cost of capital levels. Well, weighted average cost of capital is just the WACC, which you probably heard from your previous courses in finance. The higher levels of return on equity in periods when revenue and profits are grown will also be represented and will characterize highly geared company. Unlike dividends on shares, interest on debt has to be paid irrespective of business performance, which means that providers of debt will be first in line to get back their money. Highly geared companies, therefore, will face a greater risk of insolvency. Limits of the solvency fall into the area that company might not be able to take on additional debt at a reasonable cost. Now, a high level of gearing will typically be considered more common with companies with relative stable earnings. Most providers of debt financing will usually favor borrowers who are able to provide their debt payments with collateral. And collateral, it is just the ability to pay the debts and interests by selling the assets. We will next look at profitability ratios.